Hello, everyone. My name is Richard Leggett. I'm the CEO of FrontierView, and on behalf of my colleagues, we welcome you and we thank you for joining this episode of GlobalView. I'm here today with my colleague Elizabeth Rust, who's our senior analyst for global economics, and we're here again to talk about some of the major macro issues that our multinational client base are grappling with. Elizabeth, welcome.
Thanks, Rich. Great to be here again.
As we sit here today, we're waiting, just happens to be a day where the Fed is going to come out with its latest view on interest rates. And overnight, we've had an escalation in the war with Russia war with Ukraine. So never a shortage of topics to dive into. Having said all of that, for this month's episode, I think given that most of our clients are knee deep in their planning process for 2023, I wanted to see if we could focus our overall discussion a little bit over the horizon and center our three big themes on the global outlook for 2023. I think this will help inform our clients who are having to right now make very difficult investment choices and decisions about where in the world they should focus their resources. And these are very difficult decisions because, as you have written in our 2023 Global Outlook report, we believe that the global economy is likely headed for a recession in the next 12 months, and that suggests narrowing opportunities for growth. And companies obviously can't just sit back and expect the same growth we've seen in the past and we saw coming out of the pandemic and also at the start of this year. And so it makes it a very difficult and honestly, in my recent memory, the most difficult planning season that I think our clients have had to grapple with in a long, long time. And that's saying something because I thought the pandemic was a difficult season for doing strategic planning. So with that, I was hoping we could introduce at least our big topics for today's episode.
Sure. And yeah, they all more or less touch on how we see the global outlook through the end of next year. And so kind of first off, where will growth come from next year? As you alluded to, it seems like a pretty gloomy picture. So, where will we see growth? Second, the issue of the dollar and how companies should manage FX in light of our expectations for FX and the dollar next year. And then the third question, I think, will continue to be a big question for the next several months and through next year is what will it take for inflation to come down?
Great.
Yeah, so I think maybe we can launch right into this first one. And I think one sort of key theme or issue that emerged in the Global Outlook report for 2023, obviously, is a pretty pessimistic theme about the global growth situation and the overall operating environment. As you indicated, we're expecting the global economy to be in a recession at some point in the next year. And one thing I kind of want to take a second to do is just pat our research team on the back for a minute in how accurate we've actually been, despite kind of all the gloom and doom and everything, how accurate we've been in characterizing it and exactly the nature of it and the timing. Particularly how we've been kind of on the pessimistic side of consensus for most of the last year, ever since we saw this big rise in inflationary pressures late last year. And then, of course, following Russia's invasion of Ukraine, we've been accurate in characterizing actually for several months heightened recession risks. And that is basically now materializing where you're seeing a number of other research organizations make the same calls. And part of the reason why we've been able to get this right is that we've focused our analysis on the global outlook on kind of a framework centered on three key drivers of uncertainty. So obviously there's lots going on in the global outlook, lots of near certainties in terms of how we see things going. But then there are three key drivers of uncertainty. One is China's zero COVID strategy. Two is Europe's energy supply situation in light of the war. And then three is Fed policy. Obviously, all of these drivers individually matter a lot for multinational operations. China's zero COVID strategy, for example, has been, a real challenge and nuisance for companies operating in China for the last year or so. But it's also a big question for the global outlook since it determines China's growth, demand patterns, China's manufacturing activity, which affects global manufacturing activity, commodity prices, go on down the list. So by focusing on these three factors and really monitoring those very closely, that's how we've arrived at our assessment that the global economy is likely to be in a recession sometime between the now and the end of next year, with about a 65% probability.
No, and listen, I think it's great that the research team set out this framework, and it's really led to being accurate. So congratulations on that. At the same time, I think obviously it's a challenging environment for our clients, and there's a lot of, I think, gloom and doom. So I have two questions. The first is, if we are a high probability of global recession, which I tend to agree with, the question is it how, and you might not have a perfect crystal ball on this, but is this a long-lasting global recession or is this a short-lasting global recession? So that's question number one. And then secondly, given that our clients are, are really struggling with kind of how to think about where to focus resources, I'm wondering if you could maybe give us a sense of, put your client hat on, where are the bright spots in all of this from a market perspective? What are some of the resilient markets that maybe our clients can emphasize in 2023 or in this period of slowdown to capture outsized growth on a relative basis?
Sure. So starting with your first question about kind of the timing of how we see this. Generally, we're painting a pessimistic picture for most of 2023. Our forecasts in general for average growth next year are historically very low, 1.6% growth, real global GDP growth for 2023, which compares to about 3.5% in the 10 years before the pandemic. So it's a substantial slowdown. But that masks some kind of underlying distinctions in terms of the timing of how we see this. So in general, we're expecting US and Europe to enter recessions pretty soon if they haven't already, beginning in the fourth quarter, potentially as late as Q1 2023. Obviously, those account for a large share of global growth. So does China, which is in the throes of a major slowdown right now.
Elizabeth, just because the U.S. has been kind of negative GDP growth for 2 quarters already, is that technically a recession already, or because you're saying Q4? So I'm just curious the definition there.
Yeah, this has been obviously a point of debate for the last several months in light of a lot of confusing signals from U.S. data. A technical recession is defined as 2 negative quarter-on-quarter quarters of growth, so 2 negative quarters in a row. We do not take the same view in light of what has been the drivers of those negative figures for Q1 and Q2. Probably a simpler way to think of it is real consumption negative, is real investment negative, and or are you seeing a deterioration in the labor market? And in the first half of 2022, the answer for the US economy for all 3 questions is no. So that's why we don't consider the US to have been in a recession already. But we're expecting some of that to start setting in, again, potentially as early as Q4, if not, then likely Q1 of 2023 is when we would start to see real consumption declining, declining real investment, and potentially some deterioration in the labor market as well. So that's more how we see and define recession, a little bit of a broader view than the technical recession definition.
Okay, thanks. I didn't mean to derail.
Yeah, no worries. It is a tricky question and one that we do get a lot from clients as well as they're thinking through all of this. So in terms of the timing for recession in the global economy, so again, for the first half of 2023, it's difficult to envision much improvement in the overall situation. But there's some potential for improvement in the second half of 2023, and particularly by Q4. And again, if we think about the framework we set out, it's actually really helpful for thinking about this. If you think that China's zero COVID strategy, Europe's energy supply, and Fed policy are some of the 3 key drivers of the outlook. if China exits zero COVID by sometime in the second half of 2023, which is possible, I would think it's actually still our base case that that will happen, you will see a pickup in growth, pickup in economic activity in China, pickup in consumer spending. All of these things will be positive for global growth dynamics. It will also make it easier for multinationals who are operating in China, sourcing inputs from China, et cetera, in terms of reduced supply chain stress and other things like that. We may also see an improvement in Europe's energy supply situation by that point, end of 2023, because we're probably in the worst phase of that right now, where Russia's cut off the gas to Europe, and Europe is sort of scrambling to cobble together other energy sources in order to get through this winter. If it manages to do that and then continues to make energy investments thereafter, then starting by next winter, things would look quite a bit better and you would see some improvement in the European economy. So for now, we're quite optimistic as things go on through 2023. And so we tend to suggest that multinationals should generally plan for that in terms of how they time their recovery. But with all that said, depends on what markets you're operating in, depends on what industry you operate in. So there's a little bit of nuance beyond that, and is something that we highlight in all of our research across various countries and industries. But again, the way clients put it to us a lot is, when will things really start to get better, because we're tired of all the negativity, and we'll say maybe by late 2023.
But there are some resilient markets for next year that you want maybe you can highlight for us, where there are some pockets of growth.
Sure. Yeah, so just to illustrate our real average GDP growth forecast for 2023 across all the markets we cover. Obviously, global average is low, as I indicated. You've got a lot of markets here in red and orange, red indicating negative average GDP growth, which certainly means a recession. And then even a number of the markets in orange will be in a recession for part of 2023. So those are the markets where we're expecting greater headwinds, more challenges from an operational perspective, and more challenges in terms of finding growth opportunities. But in some of the markets where you're seeing more green, there are some opportunities there. They tend to be concentrated in pockets of sub-Saharan Africa and the Middle East, as well as India and Southeast Asia. So these are markets that are relatively resilient in this environment. For various reasons, for a lot of sub-Saharan Africa and the Middle East, this is because these are commodity exporting markets, and they will continue to benefit from what we expect to be still a pretty high commodity price environment. India and Southeast Asia are a little bit more insulated from worse spillovers. They've got a lot in the way, in the case of India, resilient domestic demand and consumption to rely on. Southeast Asia, in terms of, frankly, still some recovery from COVID in terms of getting manufacturing activity back up and running again. So those are some areas where we're seeing some more resilience. Another way to look at it, and another way we illustrate this, is to look at the change in average real GDP growth from 2015 to 2019, so the 5 years before the pandemic, compared to recent trend. So put simply, blue markets are the countries that are growing faster than they have for the last few years. Yellow indicates growing about on trend, similar growth to the last few years, and then orange is where you're seeing a big deterioration from what we've seen. So, orange is where you're going to face more challenges, and obviously China is a big one there in light of the substantial slowdown we're expecting. But again, some pockets of resilience in parts of the Middle East, Sub-Saharan Africa, and LATAM when looked at from that perspective. Now, for some of these markets, if you look, for example, at Venezuela and Angola, they're bright blue because they were growing so slowly in the period from 2015 to 2019. Negative growth, actually, in the case of those economies in light of some, challenges they were facing in that period. But in some other cases, this really points to a point of opportunity. This is short term, so this is really focused on just right now in 2023, but these are kind of short-term areas to look to for some potential opportunities next year.
Okay, super. I wanted to maybe turn to our second topic, which is you talked about the FX and currency pressures, and boy, we've seen some dramatic moves, not only in the emerging market currencies, but really dramatic moves in the euro and the pound as well. So can we talk a little bit about what's driving this, and then what you see as kind of the outlook, how this all plays out?
Sure. So just to illustrate actually the point you made about, how dramatic some of these moves have been, how much depreciation we've seen in a number of currencies against the dollar in 2022. This chart basically shows the time series and local currency value against the dollar since January 1st. And you've seen, obviously, in the last several weeks, lots of orange indicating lots of depreciation of most major currencies against the dollar, with just a small handful having appreciated against the dollar. Obviously, Russia is kind of its own case, capital controls, parallel markets, etc. So we'll leave that one aside for a minute. You've seen a little bit of resilience in currencies like the Brazilian real and Mexican peso, for a number of reasons, partly due to the fact that these are oil and commodity exporting countries, so they've benefited a bit in this environment. Also due to some actions on the part of their central banks. But those are exceptions to the overall rule. The dollar has surged in the last several months, and most currencies have seen a lot of depreciation. And as you note, it's not just emerging market currencies. That was actually what we as a research team and a lot of people were worried about early on in the year when we started seeing the Fed hiking rates. The question was, are we going to see, large scale emerging market currency depreciation and debt crises? And it's kind of yes and no. Obviously, some of the worst performing currencies are emerging markets, the Ghanaian cedi, the Turkish lira, Argentine peso, etc. But actually, as a group, developed market currencies have performed worse this year. And so the British pound, the euro, the Japanese yen, the Swiss franc, it's going down the list, are performing quite poorly against the dollar. In terms of the drivers and our expectations, it's caused by, Fed rate hikes, global uncertainty, everything we were just talking about a negative outlook drives investors toward the dollar. As well as in the case of a lot of these developed market currencies, Europe's energy crisis and all of the spillovers there. And we see those general trends in place for at least the next 6 months, probably well into 2023. There's still potential for the dollar to rise further and for other currencies to depreciate further against the dollar.
So if we're in this situation for the next 6 months or perhaps longer, what are some of the strategies that you're advising our clients that they should pursue to better manage FX pressures and volatility as they head into their planning, as they're doing their planning and head into next year?
Yeah. So first area to advise is to, monitor FX pressures and exchange rate performance, and also to take a look at our forecasts and expectations for local currency value against the dollar for next year, to heed our overall general expectation that the dollar is likely to continue to strengthen against most currencies, because those are direct plans that will factor into expectations of financial performance and overall sort of expectations for operations next year. There's a lot to say on this subject, just a couple of highlights, but it's a challenging environment for a lot of multinationals who, had certain expectations about local currency value against the dollar, had certain revenue targets, and then especially if they're US-based multinationals, face the challenge of repatriating profits from abroad and having them be valued much less in US dollar terms. We've also heard clients say this is a challenge in terms of, investments made in US dollars, and then again, sort of returns that are yielded in foreign currency, and just, have really resulted in some deterioration in financial performance resulting just from these currency pressures. So if, continued monitoring of this will limit the potential for some of that to happen further next year. And then there's a lot, companies can do to address sort of various issues associated with FX pressures. And one is FX access. And this is, the case in especially emerging markets where you've got on paper, not much FX depreciation, but you've got a fixed exchange rate regime. And so that actually creates issues with FX access. And that's actually a theme we heard a lot about in our recent virtual executive roundtable for sub-Saharan Africa, where this is a big issue. And we've heard a number of strategies that companies are pursuing in this environment, working more closely with local partners, extending payment terms for those that are facing FX access issues, accessing the parallel market in some cases. If this all sounds really confusing, it points to the challenges of managing FX and access to currency in this environment. But there's, a lot of recourse that companies can follow if they stay ahead of this issue.
Okay, thank you. And yeah, if clients are interested, we can dive deeper in that in either a subsequent episode or on a one-on-one basis. All right, I want to just watching the clock here. I want to kind of get to our last question, and this one I'm excited to hear your answer to. And the question is, what will it take for inflation to come down? I think we were somewhat disappointed in the last print we saw in the U.S. that it actually we didn't see it start to come down. I think that was the general consensus. So it feels like it's stickier for longer. And as we're recording this, the Fed is meeting to decide on its next interest rate policy. And certainly by the time many of our clients are viewing this episode, we'll know the answer. But the question here is also, will the Fed take a more aggressive stance and supercharge their rate hike by 100 basis points? And likewise, earlier this month, we saw the ECB hike by 75 basis points, which is really an unprecedented hike. So there are things going on with central banks that we haven't seen in a really long time. And obviously, that's a response to inflation. And your insight here on when we might see this start to come down and what it will take to do that, I think would be very valuable.
Yeah. You alluded to a number of recent central bank decisions this week, and those are kind of two of the most interesting recent ones. But we're actually expecting monetary policy decisions, I believe, from about 12 or 13 major central banks around the world this week, including the US, for example. And actually, it's interesting, it's from a variety of different countries. And with the exception of China, which made a decision just a couple of days ago to hold rates, because China is one of the few countries where you're not seeing much inflation, as well as Japan, which is likely to do the same thing. Every other central bank meeting this week is likely to deliver a supercharged rate increase to try to battle inflation. And that covers countries like Brazil, the Philippines, Taiwan. Just a number of central banks around the world are grappling with this problem, and they're probably asking themselves the same question: what will it take for inflation to come down? It's a tricky one that central banks are facing right now.
But I know you have the magic answer, so let's hear it.
Yeah. So I guess one thing to note: central banks have already been hiking for the last several months. And you can see this is a selection of major central banks, the percentage point change in their policy rate since January 1st. And a number have been hiking for quite a while, even pretty quickly ahead of the US Federal Reserve, shown in black. And yet a number of these markets are still facing a lot of challenges with bringing inflation down. So I think this kind of begs the question: is monetary policy even working if central banks have been hiking and inflationary pressures remain really strong? Obviously, it's tempting to say it's not working at all. A couple of caveats to that: inflation could be even higher if central banks hadn't acted, the way they have up till now. And it's important to take into account that central bank action in the form of interest rate increases or quantitative tightening, other market interventions, they take some time to come into effect. In general, the lag is about 1.5 to 2 years. It's generally estimated for monetary tightening to actually feed into lower inflation. So that's a lot of why US inflation, for example, remains quite high. A lot of other drivers of inflation going on there, but to the extent that Fed action can take care of it, we wouldn't actually have seen much effect yet because the Fed only began hiking earlier this year. So that it speaks to the challenge that central banks are facing. It speaks to the fact that they know this is actually a medium to longer term problem. And so they're trying to get at, trying to bring inflation down actually starting 2 years from now by hiking now. But they're, they face a number of headwinds to doing so. And maybe, kind of some of the news coming out this morning with Russia's mobilization and this massive escalation in the war in Ukraine, they face ongoing uncertainty in the global economy that tends to be inflationary on balance, as it relates to commodity supply disruption, supply chain disruption, disruption to food supply. So all of these things tend to be inflationary, and that's what central banks are struggling with. So honestly, if you ask me my view, it's going to take a lot to bring inflation down, and we're probably seeing higher inflation for at least the next 3 or so years. It may have peaked in some markets. We can probably hope so, but in general, it's going to take quite a while to come down to what we've been used to.
Yeah, I think that was my question. Is it'll take a while for it to come down, but has it peaked? And if it hasn't peaked, when do we at least see it peaking? Because I think if the market and our clients can feel like we've seen the peak of it, you can plan around that. But if you're not sure what's going to happen, it makes it very, very challenging.
Yeah. So I would say, putting it as simply as possible, our if we take the US, for example, our base case expectation is that inflation has probably peaked or is about close to peaking right about now. But it really depends on what happens with the war and a number of these other global uncertainties, what happens to commodity supply, etc. I would say if we get stabilization in oil prices, continued declines in shipping rates like we've been seeing for the last several weeks, and just an easing in some of these pressures, then I think we can expect a lot of these other drivers, wage pressures, core inflation, etc., to eventually start easing as well. So that would be kind of the best case. But again, we're monitoring considerable upside price risk for commodities, for supply chain costs, just in light of all this global uncertainty. So I would say, again, it's probably peaked with slight kind of majority probability, but doesn't mean that we can kind of comfortably assume that it has.
Yeah. Okay, that's super. Yeah, it's kind of your demand destruction thesis coming to play here, as well as a counterbalancing force. Elizabeth, thank you so much. We're up against time now, but this has been super helpful as always. So thank you for that. Thanks also to our producer who is behind the scenes here, Madeline Gordon, for all of your help in producing this episode. And most importantly, thanks to our audience as well. I strongly encourage each of you to download our Global Outlook report. And importantly, reach out if you would like a briefing for your leadership teams. There's never been a more important moment in the year to really be understanding the canvas you're going to be painting on for the next 12 to 18 months. Finally, as a reminder, all FrontierView clients can schedule research briefings with any member of the FrontierView Global Research team at any time by scheduling through your client services manager. And of course, all of FrontierView's research, award-winning data, analyst insights are available and always updated on the FrontierView desktop and mobile applications. This concludes today's GlobalView episode. We look forward to seeing you again and speaking with you again soon. In the meantime, be well.